the talk as well. So let's get on with it. A heck of a lot of new stuff and the market update to give you. You should be able to see my screen loud and clear through all of this at the same time as being able to see me. So I'll tell you what I'm going to do. As well as the normal stock market update that I do every week, I'm going to give you something of a bit of a bonus. What I'm also going to do is go through some of the exchange traded funds, not many, but some, which are generating over 40% per annum. Okay. These will be funds which generate not just a 40% return in the previous 12 months, but also projected to do so going forward with low volatility to the downside. So I will cover some of those requirements going forward in those. One of the other things I'm going to do in this webinar is also take you through what some of the big elite wealth management banks, in particular these, have either upgraded to a buy or confirmed buys in the past week, and which have met my filters. So we filtered their selections from, say, Goldman Sachs Wealth Management or JP Morgan Wealth Management, even more so, and I'm going to give you some of those which I am or have already put in my pension. So I'm either happy to put in my pension or my son's junior ISA, or I already just have today, basically. And I will also, thirdly, and some of these have come from hedge funds, give you the ones which are more tactical, intermediate term momentum investments, which again, I'm happy to have in my son's junior ISA or in my SIP or my wife's SIP as well. So we've got three sources of information. We're going to look at my own spreadsheets. I'm going to take you through that in this webinar. We're going to go through my own spreadsheets. None of these meet my criteria, so it just shows you how picky I am. When I say I filter, we're going to be filtering through not just my own spreadsheets, but also we're going to then see, okay, well, which hedge funds have been generating 40% per annum for at least the last 3 years? And do their stocks that they currently hold also meet my criteria? If they do, great. If they don't, then no. And then also with the big wealth management banks, which ones have they just bought and told their wealthiest clients, which also meet my criteria? And finally, some exchange traded funds, which also 40% is the buffer. So whether it's hedge funds producing 40%, whether it's stocks or funds producing 40% per annum, are the projections there? Can I filter it on valuation, growth, income, and so on? And I'm going to give you those, as well as, of course, the stock market update. So you've now got the agenda and the itinerary, as it were. So let me carry on and tell you the rest. By the way, in case you're wondering why I'm outside number 10, I realized earlier I hadn't told people. So let me just take you through some of these pictures. That is from the early morning BBC newspaper review, often, well, for about 10 years, actually. Weekly, then fortnightly paper reviews. Number 10, because I've had various roles with past governments and present one as well. So I won't go into much of that now, but it's all centered around entrepreneurship, technology, innovation, and international affairs. So that's why I was there. Anyway, the rest of the stuff I'll cover later on. You don't want to know my life story. You want to know why Nick Train apologized for poor performance. This is from earlier in the year, and I came across it again, and it reminded me one of the reasons why people are here on, why there's nearly 400,000 followers on my TikTok and why there's so many people in my webinars. One of the key reasons is because the poor performance from their pensions and these fund managers. Now, for those who are new to all of this, and let me know if you are new to all of this as well. This isn't a Forex webinar. So if you're here for foreign exchange, it's something else. The screen's not frozen. You should be able to see me at the bottom. Okay. If at any point the screen gets frozen, just refresh your screen. Okay. I'm going to publish a poll as well, so you should be able to see that. Is the big asset managers have so much capital under management that they have to divide it up by geography. So it might be you can only pick UK stocks. They say to one fund manager, to another, they say you can only have growth ones, you can only have income ones, and so on. So those people are picking from a very small gene pool. If they pick from a very small gene pool, then when they look at what they're allowed to pick, inevitably they're picking from ones which are highly unlikely to do well because they're picking from a small gene pool. When you consider that there are 10,000 companies you can put in your SIP or ISA in the United States, the United Kingdom, and Europe, all of those could go in your ISA. There are actually very few companies you'd want to trust your pension with, contrary to what you might think, because so many of them, well, just have a look at some of these, down 92% from their highs at 81. You might think, well, that's a turnaround situation. Well, they have many gaps on the three sets of accounts they produce. They produce a balance sheet, a cash flow statement, and a P&L. And if they have on all three of those big holes, such as poor cash flow, poor growth, poor valuation, then we know from the academic literature, let alone common sense, those companies are probably not going to do that well unless they fall into the category of, well, let's hope somebody does a speculative tweet about them. And that's not what I want in my pension. So none of these would actually meet my strict criteria. Why do I have criteria which are so strict? And surely there are companies which won't meet it, which do well. That's correct. I'm not looking for perfection. I'm just looking to make sure what's left is not rubbish. Because, and even then I can't guarantee they'd go up, but at least we've removed overvalued companies which aren't growing, which aren't producing dividend yields. These poor sods like Nick Train can't do that because he's been given a list of 100 stocks and told, here's $1 billion, go pick from only this 100 list. No wonder your pension therefore stinks. Okay. In his case, he was only allowed to invest in the UK market. So he was absolutely buggered, right? I'd give another example. In years like 2022, so here's another reason why your pension stinks. In years like 2022, guess what happened? 50% loss. Scottish Mortgage Investment Trust. For years, they do well when the market's going up, and that's when they do all the marketing and get your money in. In a year like 2022, when we said to people, I'm sorry, we're going to have to hold cash. In January, we said we'll have to hold cash. Then February, we'll have to hold cash. Well, these people can't hold cash, these fund managers. So they just made you lose 50% of your mortgage. And they said, oh, no, but we manage money for pensions. Yeah, but how did you lose 50%? Oh, you shouldn't have given us all your capital. And they still hadn't recovered. The last I looked, they're barely up from those levels. Anyway, so one of the things we're going to do is not just look at my analysis, because you don't want to necessarily look at mine. One of the things we also do is we just cross-reference, because we don't have a monopoly on brilliance. We cross-reference with multi-billion-dollar hedge funds as well. One of the things we do. And see if they've been generating over 40% per annum for the last 3 years. Then we look to see what they own. This is one example. You as a retail investor can't buy into these because retail can't buy hedge funds. It's as simple as that. And I set up mine in 2004, and I wish I had 4 billion under management. We don't. We still don't, because, well, we don't. They've got 4 billion. So we're going to try and look at their ideas and see if any of theirs fit our filtered criteria as well. The reason we do this belt and braces filter is because we want these kinds of returns. That's, by the way, the NASDAQ, 600% ups since 2009. That's the UK markets, the FTSE All Share, up 47%. So all those UK pensioners who are poor, they're not poor because Britain has made them poor. They're poor because their fund managers have only been investing in that, not so much that. And you might say, well, have I missed the boat? Well, anyway, these can be in your SIP and ISA. So we're going to have a bias towards the US, but not just the US. You might say, oh, currency risk. Well, there's a big difference between 600% and 50%. If you're worried about a move on currency, which actually has been in your favor since 2009, significantly, then you needn't, because of the levels of growth in any event. But that's not the only thing. It's not just that we're going to look at that for that reason. I first wrote about that in my book, one of my many books. You can see this. For those of you watching the webinar, you'll be able to get a copy of this in just a second. What happened is, in it, I detailed in 1999 in my Financial Times column why I was looking at a bigger pool of stocks, which included the US. Not because I knew it would go up, because I didn't have a crystal ball, but because more choice meant more filtering logically meant better returns. Now, this is how long it takes to double your money, the rate of return you need in order to double your money. The rate of return you would need is, well, if you do what your fund manager does and give you about 5%, then it's going to take you 14 years. If you can do what, for instance, the S&P just as an index has done in sterling terms over the last 10 years, then it would take you 5 years to double your money, because that's what it's done. If you might be able to just improve it, maybe with a bit of free knowledge I'm giving you on these webinars, maybe it'll take you slightly over 3.5 years. And you might say, well, I'd rather just have an index tracker and do it in 5. Well, fine, that's okay. You certainly don't want to be here. That's my point, right? So even if I just do a little bit better for you, then move you away from your existing fund manager into more, removing the fund manager alone will give you 1% return more. To open the SIP and ISA yourself and educate you and give you the confidence to be able to do that, then hopefully you'll be able to double your money a lot sooner than they would. They're going to take 14 years. Maybe it'll take you 10. Maybe it'll take you 6. Maybe you'll get closer to just an index tracker, which still means doing nothing by yourself, and that's 5. Okay? That's part of the goal put in very, very simple terms. That's my book number 19, published by the Financial Times, yet to come out, so don't pre-order. This is not a plug. Also, please read that. This is not individual financial advice because I don't know you individually. It is education and information. It is not a solicitation to buy any of the securities that I'm going to be mentioning to you because I don't know your circumstances individually. By the way, I did a poll on the other screen. Will the FTSE be high by the end of the year? 53% said yes. So that's interesting. I'll share that poll now. What about the Dow? Let's ask if you think the Dow will be high by the end of the year. I've got a sneaking suspicion I know the answer to this already. I'm going to, for those who are watching the webinar, give you a copy to download the book now. So I give you the bribe. So this book for free, you can download it. I'm giving you that as well, and just showing 1 or 2 other files that I've got as well. The book will give you everything that I'm telling you now. Most people don't read books. That's why they do webinars. That's a multi-billion-dollar hedge fund who's endorsed it. That's Bloomberg Television, and that's the Financial Times. Okay, lovely endorsements of what I've written. So that's free to download on the webinar. If you don't know where the webinar is because you're watching on TikTok, it's albishpatel.com/latest shares. Now, everything I'm going to tell you carries on from what I've been teaching since I had a lot of hair, which is from my Financial Times columns, 200 of those, as well as from my Bloomberg TV show. And as I said, my goal is I want everybody who's watching this, who's frustrated with their pensions and their financial advice, to do what the government wants you to do anyway, which is have SIPs and ISAs and save and kick out the bloody middleman, but you lack the confidence. So we need to be able to build that confidence in you, and the knowledge that I'm going to give you helps as the first step to build that confidence. This is the market in terms of valuations. So let's start with the update of what's been going on. You're paying $27 for every future expected dollar of profit in Microsoft. You're paying $30 for Apple. Now, if valuation was the only thing that mattered, then it'd be simple. Just buy the greens and sell the reds. But valuation isn't, because the stocks in red, i.e. the overvalued ones, are the ones which have been doing rather well. And that's because beyond valuation alone, things such as growth matter, growing companies. So we take all this data, we crunch all these numbers. Then we have humans, including myself in my team, who will go over things and say, right, have we checked for valuation? Have we checked for revenue growth, the dividend yields, for consistent price performance, average returns, low volatilities, cash flow? And then the reason we know to look for those things other than common sense is because the academic literature, including Nobel Prize winning literature from Richard Thaler, Daniel Kahneman, and Eugene Fama, shows that to be the case, that these are the factors to look at which are important. So why don't people do it? Well, for the same reason I guess everybody just doesn't give their money to Warren Buffett. They just don't do things. Earnings calendar, S&P 500. These are the ones who are going to be announcing results. I'm going to come to PepsiCo in a second, I think a bit later on. None of these are going to move the markets. Okay, so you don't need to worry about earnings moving markets anytime soon. If you're watching this on YouTube or even on TikTok, don't forget to like and follow. So like I said, the key factors, just so you know, of the stocks I'm going to talk to you about, whether they've come from hedge funds generating 40% per annum, or whether it's exchange trade funds, or whether it is any other source, the key thing is they all have to meet my filter as well. Ankit, yeah, it'll be the same URL later tonight you can use. So my filter will be value growth income. Oh, by the way, please let me know what time's good for you for me to do these. Is it 6 p.m., 7 p.m., 8 p.m., or 9 p.m.? If you wouldn't mind sharing with me, that information. By the way, 50% of you said the Dow will be higher by the end of the year. 16% said no. So the vast majority of you think it will. Let's ask you about who's going to win the US election. Now, I've written Biden, but ignore that, and you know what I mean. Harris. Okay. So I need to tick the valuation box. I know I'm repeating things which many of you will know who've watched this before I give you the update, but I think it's really important. They need to be undervalued. They need to be growing. They need to be producing dividend yields, because that's what the Nobel Prize winners and the academic literature and the data showed us. And I have this in my books if you want to read about it. I've written about it in my Financial Times columns. I've explained it a million times on my Bloomberg TV shows as well. Cash return on capital invested comes from Goldman Sachs Wealth Management, 30% per annum for the companies in green, basically. They're the ones who are in the top quartile by Croakey. Not guaranteed to give you that return, otherwise it's a bank account and we'd all be driving around in private jets. Momentum comes from the hedge fund industry, companies like Winton Capital or AHL, who are rather good at explaining what they do. We know there is evidence of momentum persisting, but not guaranteed to continue. And then these two come from the hedge fund industry as well. Sortino is high average returns, low downside volatility. Alpha is if there's a tailwind in the market, you do even better. If there's a headwind, you don't fall as fast. You're a resilient company. And surely you want those. And the reason we look at these numbers and then mark them in green is it makes it a hell of a lot easier to filter. And we go through 10,000 of those. And that's 90% of the bloody work done. Okay? Take the academic evidence of what you should look for it, and then have a straightforward strategy of how to implement it. Now, beyond that, there's something else I want to show you right now. That's just stocks, though. Alpesh, I need to know for my age, how much should I have in stocks? I'm going to show you this now. How much should I have in stocks? How much should I have in other asset classes? Okay, so let me show you some good stuff. Okay. First of all, I'm going to actually just show you what Bill Gates has gotten, Goldman Sachs and all the rest of it, for those who are interested. Now, that doesn't mean I go out and buy those things just because Buffett's got that. But what I want to show you is that the two big billionaires there, Bill Gates and Warren Buffett, they happen to have, I'll try and zoom in so you can see better. After their fifth largest holding, they've got less than 5% of their stocks in 5% of their money in any individual stock after their first 5 holdings. So Apple, Bank of America, American Express, Coca-Cola, Chevron, then everything else is less. Doesn't mean you go out and buy it today. That wouldn't make sense, because if you did that, that'd be sort of ridiculous, for the simple reason that were you to do it today, they might have bought it years ago and they're just earning off the dividends. But I'm just showing you the level of concentration in order to get a superior return. Okay, now we'll come to that. This is from Goldman Sachs Wealth Management. It's not controversial. I've published it in my books before, and that's why I'm showing it here. And basically what it shows is years to retirement, and that's what will make dependent how much you have in stocks, how much in fixed income, for which read cash. Okay, high interest cash account, and tactically based on the markets. Now the problem with this is there are times you need to go just purely into cash, like 2022. Okay, that's critical and that's important. But this is really important for you to know. So what you might say is, actually, Alpesh, for my risk appetite, and we can finesse this for individuals, but for my risk appetite, I want 20% in cash, 20% in low volatility exchange traded funds, of which there are 5,600 we filter through. Okay, everything from treasuries, right? And we need those to be all green based on this as well. I mean, listen, this is my future, my son's inheritance, my wife's inheritance, and my old age pension. So I'm not going to mess around with taking stupid risks. Okay, you can gamble all you want to, but one thing I know about making money is you don't do it by being the gambler. You do it by being the bloody house. Okay, by knowing more. So you got to, all of these. Now, you might say 20% in low volatility, i.e. volatility below 5%, exchange traded funds, and 20% in cash, and the rest in equities, 20 equities, for instance, some degree of concentration. Now, that'll depend on individuals based on their risk appetite, but I'm just showing you how you work it out based on your various appetites. Anyway, past week, this is what the markets have done. Bit of a mixed bag, given what's going on in the world. Nothing particularly that's worrying me. Let's take a deeper dive. By the way, for the past year, it's this. Now, when past years look like this, I might look cleverer than I actually am, because of course I've got a tailwind. So my job is to make sure that my clients are in a position to take advantage of this. Okay. Now, they might not get the 168% NVIDIA, although we did select it in January of 2023 because it came up on value, growth, income, cash flow, Sortino. We didn't know it was an AI play. Don't care. We don't buy into narratives or try and outthink the market. You can't do that for 10,000 stocks. We did it because it ticked all our numbers. And guess what? Yeah. Well, there'd be something wrong with our approach if it didn't tick our numbers. If you think about it, the approach is engineered to ensure it tries to pick up things which are high growth, high momentum, and so on. Anyway, so in years like this, we should do well because there's a lot of green to be hit by. Okay, what are the markets over the past year? Well, yeah, and indeed, the Nasdaq's up 34%. So if since last September, let's say end of September, last October, your pension isn't up 34%, then speak to your wealth manager because the Nasdaq and the S&P as indices are up that much. Okay, so you should have done significantly well. Now, that isn't really the problem. The problem is, well, what about the years when that doesn't happen? You've got to hold cash. You've got to have a method for that, which we do, thankfully, and I'll come to that later. But why don't most people's pensions do this? Why is Nick Train apologizing? Because they've got so much capital to invest, they can only put it in a few stocks, whereas you've got the liberty to pick from a bigger bunch, which is why the government created SIPs and ISAs. Get rid of the middleman, let the smarter people have their savings themselves. Okay, so where's the S&P? Where are we at the moment? Well, you can see this wonderful trajectory. Now, I'm going to show you this since the last 5 years. You will get 1 in 5 years, that was 2022, where you're just holding cash. Now, you might say, well, I can sit through that, Alpesh. Well, I'd rather not. I'd rather, as we did, get in January of 23. It's all on YouTube and Telegram. You can go look at the dates and you can see what we did and cross-reference it. Is that going to do 61% in 12 months? No, of course it's not. I do let my team run a bit wild and say project forward, and even then they've gone nuts on that. There is a 1% chance of that. Okay, it's not going to happen. But they've gone and projected this forward for me. My graphics team put this together with the data guys, and so they've come up with that, and they're nuts. By the way, you should be aware that in the last 3 years, only 1 in 3 times has the S&P gone up in October. So anyway, but that's an aside. So am I worried it's a bit overbought like it was here? Not yet. I'll wait till we see any falls before I worry. Just as Warren Buffett sits on his hands most of the time, it doesn't sort of look at everything every single day. NASDAQ, similarly, coming up to overbought. It looks like this. It looks like when we were here. So nothing to worry about at the moment. Just be aware. I continue holding S&P and NASDAQ, and I'm perfectly happy doing so. The FTSE, again, sort of regional highs, should continue plodding along a bit, though some economic data suggests UK doesn't look that great at the moment. Top 10 S&P stocks over the past month are these. So let's have a look at these, given that we're doing a stock market update, and see if any of them are interesting to us at the moment. So Vistra, whilst it hit our value growth income, it is overbought, so it couldn't fit into one of our normal special situations, despite the fact that the major banks have given it a buy rating, and most times it is likely to go up on a given month and down. All of those things, all fine. It doesn't meet our criteria at the moment because it's overbought. We tend to be quite risk averse. For those of you who are risk loving, be my guest, but that's up to you. And I guess what's happening in the Middle East would help them anyway. We're not here to gamble. It's for my... the way I look at it is, would I put it in my son's junior ISA? I'm afraid I wouldn't. The only circumstances in which I might consider it is if I thought that continues and then put a stop loss here, which would mean 50% to the downside, 100 to the upside. It's not for me, but it might be for you. Do you see? You're not trying to be me, and I'm not trying to be you. Constellation Energy was one of the big movers this past week, and again, my team were asked to project forward. What they do is a bit like seen from Billions. They pitch to me and they say, oh, we've got this. It's got a 7. So we've got value growth income. We've got some buys out of the big banks. Most months it's up, Alpesh, etc., etc. Okay. And I turn around and say to them, no, it's, I haven't got the monthly. There isn't enough data for a monthly MACD and momentum on it. Not for me. But others, they might love it. Okay, this is going to be for the program only. So is Wynn Resorts. So is that. So is that. I'll come to others. Now, Tesla, you all love, don't you? So it doesn't meet our value growth income of 7.8, so it can't be a special situation. It hasn't come on our filtered list at the moment. So the only way it'd be on, none of the banks have given it a buy very recently, none of the major ones anyway. So you'd really have to look at it as a pure momentum play. Not for me, I'm afraid, at the moment. That might change if it breaks out from above these levels, above 250, which I'm sure it will at some point. But it's just a bit premature for me at the moment. You might want to put a stop there and set a target to that. Entirely up to you. Not for me at the moment. I want to see a bit more evidence. This gives you a bit more insight into my thinking as well. I don't sort of panic buy and think, I'm going to miss it. I'm happy to wait and miss a few points. For those of you who play poker, a bit like, well, okay, I'm going to pay to continue staying in the game, and I might have to fold later and have lost more than I needed to if I folded earlier, but I'd rather wait and have the opportunity cost and get more evidence on this. Okay, Oracle does meet value growth income 789, but it's overbought, so it can't be a special situation. Okay, however, were you to look at it in different ways, you might say risk reward on a projection of 57% with a stop loss there means you've got multiple up to downside. Not for me in that regard on a special situation, but outside of the normal program that I've got, yeah, that I could have. Okay, 8 there, nicely moving up. This fits the program. Okay, 7, 8, or 9, it's a special situation. 45% would be the target there, and I would just put a simple stop here. It is below $100, so it's likely to be more volatile than most, and it does have a significant number of months where it's not gone up, and it's a very volatile stock. Okay, so it's not going to be suited for anybody who doesn't like volatility. And it would be high risk. So for many people, it'd be like, no, I don't want it. Okay. These elsewhere. I continue holding my Apple. I continue holding my Amazon and my Microsoft. And Meta, you know, I sold out of in April, not because I thought it was going to go down, but because it becomes such a large part of my portfolio and my son's portfolio. On YouTube, you'll get more of my stuff. Netflix, I don't own. It's an 8, but it's overbought, so it can't be one of our special situations. However, do you want to look at that projection continuing forward, in which case you'd be looking at a 78% return, and you'd put a stop loss here. So you'd get a multiple upside to downside. Fine. Not for me, because I got enough I've invested in. Can't buy a bit of everything. As I've shown you earlier, I don't spray and pray like fund managers. Walmart's at an 8. Again, overbought as so much is, so just be warned. There's a lot which is overbought and a lot which is going to fall at the same time. Netflix and Walmart will fall at the same time if there's a severe move down. So, you know, if you've got both, you're still taking risk. But if that's your projection forward on the basis this continues, then you can put a pretty tight stop loss. So you've got minimal risk to the downside and a good upside. It's a 7, 8, or 9. It's not for me because my rules are that the MACD can't be overbought. Now, you might say, well, screw your rules. Why do you keep following them? Why do you not change them? Well, it's a bit like Warren Buffett in the dot-com era. He didn't say, well, I can't get into these. He said, look, I've got a way of doing things, so be it. And of course, then the bubble happened and everyone said, wow, you're a genius. And he didn't buy any of those tech companies back then. Okay, he didn't go around changing rules willy-nilly. CVS, 7, 8, or 9. Now starting to go. I'd rather wait until the monthly momentum crossed its own moving average. It tends to be a stronger move, but there's a lot of momentum there, looking good from that perspective. However, it is not for those who are risk averse, because look at the falls and the volatility it can have. Always think about the drawdown depth in previous uptrends. How much can it fall? How long does it take? The depth and duration, and that tells you your risk appetite. If you're risk averse, you don't want anything below $100. Okay, if you're risk averse, you want to make sure that previous uptrend drawdowns like that you could handle. That's a 30% drop. Could you handle that, and how long it takes to recover? If you couldn't, then you shouldn't be in stocks like that, and then you move on, find another. Most people are just not that diligent. What they'll do is they'll take massive stupid risks with their portfolios. One of the worst risks you can take, just give it to a fund manager. It's one of the worst risks, because you think you're taking no risk at all because you're giving it to an expert, and then you see, like Scottish Mortgage Investment Trust, you lost 50% of your bloody money. Okay. You can also follow me on LinkedIn, where I'm a top voice. I know most people hate Bill Gates for some reason, but anyway, I too, I'm a top voice like him. I've got more to come. Don't forget to look at the campaign for $1 million. What I want to show you now, my campaign for $1 million, by the way, was to teach 1 million people how to be better investors and add an extra $1 million into their pensions across their lifetimes. And it's going well. And the reason I wanted to do that is because 1 million times 1 million is $1 trillion. And that's one hell of a bloody number, isn't it? Okay. Part of that is through the books and so on. By the way, the majority of you think Trump, I can't say that word because if I say it, then it'll get picked up on TikTok as some kind of electioneering. So anyway, most of you think it'll be T, not H, who'll win in America. I can't say some words because social media hates it when you say certain words. I know, it sounds ridiculous. I'm going to reset that poll, and I'm also going to ask you, which is your number one frustration with IFAs. Now, before I go on to, well, this was the point I wanted to make about what I said in 1999 in my Financial Times column, and then what the Financial Times published 25 years later to the day, pretty much. Okay. And you can read it there on the screen. It's made my life a hell of a lot easier because I had a tailwind. It wasn't because I was clever or smarter than anybody else. It's because I had the tailwind of having more stocks to select from. And time and again, that can be the answer. Let's take a look at what's come up on our tactical momentum intermediate term investments. Now, I'm not going to go through all of these, but just so you know, they're the ones where we've got strong momentum, a feasible 40% return, preferably within 6 months, reasonable to have a 20% stop loss. So you've got a 2 reward to risk. Okay. And JD.com's come up in that, just so you know. There you go. All right. Now, what am I saying with this? Well, what I'm saying is it's the kind where we feel it's reasonable to have a 40% at least to the upside is feasible. 20% from entry would be your fixed stop loss. 12-month would be the holding period. Now, it might go further, in which case we can worry about exiting or if it goes even more. But those are what the intermediate term ones look like. And I might come to more of those later. Let me, whilst we're on the job, also explain to you what the wealth management ones are that we're looking at. This is a new thing I've done for the program, the Elite Bank Wealth Stock Buys. Okay. It's a bit of a mouthful, I know. Elite Bank Wealth Stock Buys. So the elite banks, which have wealth management divisions like JP Morgan, Goldman Sachs Wealth Management, and we're looking for the ones which 40% is reasonable, target in 12 months, multiple upside reward to risk. So if I were to go into, say, a Bank of America, and what have they recently either said buy or confirmed as a buy, is 40% or more reasonable in the next 12 months based on previous trajectories and based on momentum? And can we put a tight stop loss so we've got multiple upside to downside? And this is how we do those, because we need, not because we think we're going to get a 40% return necessarily on every single one of those, we're not, but because that gives us a buffer so that if some do even better, great. If some don't do as well, we'll have had a big buffer. The other thing which has worked out rather well has been what I call the ETFs. Now, ETF advantage, again, 40%. We need the projections, at least 40%, reasonable stop loss, 20% or less from entry. And that's what we're looking to do. So I'll give you an example. And it might be something like a coffee. You might think, you crazy, it could be India. But it'll have to be ones where we think that projection is reasonable. The volatility, the Sortino meets our requirements as well. I'll give you one more, like the S&P Utilities Exchange Traded Fund. And now you might say, well, why are you being greedy? And why are you saying 40%? That's ridiculous. Well, because that's the trajectory, that's the history, that's what they've done previously as well. Okay. Quite a few have said, one said 6 is around 6 or 7. Now I'll take this all on board. 6, ideal. Okay, we've got some 9s. Okay, got some 8s. Later than 6 would be preferred. Okay, understood. I'll take that on board of what everyone's said as well. But it's useful to know that it's not necessarily just 6s, and it might end up being a bit of a mixture now and again. Now, if you take a typical pension fund like Blue Whale, what are they doing? This is what frustrates me and why I do these webinars. And why I've been writing the books and been on the BBC, banging on about it, and on Bloomberg TV and writing the columns and all the rest of it and giving away free information. Because when I see this happen, one of the most useful things I can do in life, given that I'm in finance and we're really known for destruction rather than construction, one of the most useful things I can do to change people's lives is give them bloody education and show, listen, those pension fund managers who said, don't worry, it's okay. And I was a barrister practicing in pensions law for a while. Blue Whale down 27% in a year because they won't go into cash. So I don't care when the markets are going up that they talk about how clever they are, because any idiot would be clever when the market. My son's ISA, and he's 6, looks better than what these Muppets can do. And he's only 6, okay, because he will be told by daddy, right, 2022, hold cash. These idiots will lose everything that's gone up in the years before. And I'll give you a classic example of that actually happening, okay? I'll give you an extreme example of what actually happened. And you don't have to look at it in the sense of this particular stock, but it was what more broadly happened with the markets. If you look at something like a Meta, right, for years, and this is 2016, they're saying, oh, aren't we clever? We hold Meta, give our fund more money. Our manager's awfully clever. Oh, we get the odd hiccup, but we hold through it, hold tight. And then 2022 happens. And this happened not just with Meta, it happened with pretty much every single company. They didn't all fall as badly as this. Now, we knew to go in cash because that was a daddy bear. Momentum, average prices were just dropping across the board. Right? Very simple. Your rules have to be objectively measurable. Otherwise, they're subject to subjectivity. And that means misinterpretation, right? So that was very simple. We didn't know it was going to drop 71% in 9 months. We didn't know that. It's an extreme example of what actually happened. And then in January, we got back in because the momentum stopped falling. And we didn't know that in a year it was going to go up 180-odd%. Now, your average fund manager will say, well, your RFA, who's an idiot, will say, well, look, over 2 years, you got 0% return. It all came back. You made it back. And we'd say, no, over 2 years, we made closer to over 100%. 0 in 1 year, 100 in the other. We didn't capture the bottom or the top, as you can see. Okay. And that's an extreme example of what mistake fund managers make. They can't go into cash. So in years like that, they destroy your pension. So what happens? You're with them for 7 years. You have many years where it went up and you think, oh, well, they're really good because I've had lots of years it went up. But what they've just done is they've taken you back like snakes and ladders, 6 years of your pension gone. So here you thought, oh, I'll buy that second home in the Caribbean. In 1 year, all gone, and you've got to start again. Okay, now don't tell me, oh yeah, but they're recovered. Well, if you can take that vomit-inducing V-shaped recovery of which there was no guarantee, good luck to you. And that's the business they're in. All because they didn't have a simple rule for holding cash. My rule isn't something I've created ex post facto after the event. It's in the book. Not just this one, the 18 other books translated into 8 languages. And I've commentated it many times on Bloomberg, BBC and the like. Underperformance is rife amongst active fund managers. Well, I want people to take control of their pensions themselves and have those ways of getting the returns. And for me, it is you've got to tick those boxes, value, growth, income. If nothing else, if you say, I don't know how to tick them, I don't know what to buy, this is how I buy Alpage, that's how I do it, then at least one thing you've learned is don't even do it. Just don't even think about investing then if you've got no idea. But for me, it is this. Now, you can create your own one way or another. You need to look at the undervaluation of companies, the revenue growth, the dividend yields. Okay, cash return on capital invested. I'll show you the formula for that from Goldman Sachs Wealth Management because I follow other people's research. And what their research discovered, and they still pick stocks this way, is 30% per annum on average, not every year, for stocks in the top quartile. So I need to tick that box, but I also want to tick my extra boxes. I'm not just going to rely on them. I want to make sure it's undervalued, undervalued, revenue growing, profit growing, dividend yielding, because that's what the Nobel Prize winners showed us on the research. Okay. Momentum, Sortino, and Alpha, high average returns, low volatility of downside moves. Because what do you want in a stock? You want one which goes up like this. Okay, that's what you want ideally. You don't want ones going like that. That's what the Sortino is trying to capture. And if there's a headwind, then you want it going like this, not like this. That's what Alpha captures. Okay, now we might then, after we've got the database, think, right, we've got all this massive data. We've got a ton of data. Data is oil. Okay, it is precious as hell. We've got all this data. what do we do with it? Well, so how do we narrow it down? Well, I could just look at every single one. I might narrow it down by having some kind of tactical breakdowns. I might say, well, are there any in my list which are also in the list of multi-billion-dollar hedge funds which have generated 40% per annum for the last 3 years? And if there are, I say, all right, okay, well, I've got a tiebreaker. Let's go with this. It's like having two people with identical CVs. One happened to have gone to Oxford or Cambridge. The other one went to the University of Nottingham. And you say, well, actually, I'll go with the Oxbridge one. Everything else looks the same. You might think, what an idiot. Fine. But I needed a tie break. So that's one way in which I do it for clients. S&P's most number of guru holdings, by the way. Here they are. I do own United Health, Alphabet, Amazon, Apple, Microsoft. I don't have Citibank. Meta was added in April. I mean, I could have held on to it. There's only so much you can hold. I do continue holding JP Morgan. I did have Adobe, but I no longer. I do have PayPal. Okay, just so you know, I'm not going to go through all of these. But it's a tiebreaker. If once you've gone through the entire spreadsheet, it's a tiebreaker. The mistake most people make is they hear something in a pub or what a bloke has said in a magazine and say, oh, I'll just buy it. No, you need to start with 10,000 and filter down. Now, we might, again, look at analyst projections. Okay, any analysts from a major bank which has got over 40% per annum returns. And if you look at the analyst and you say, okay, what have they got? Does it hit any of ours? Are any of those in my list? And if they are, fine. If they're not, then I ignore it. Okay. And none of those were, by the way. So before you run off and go get them. So I have to ignore it. Right? I don't start with the analyst. I just use them as tiebreakers or hedge fund projections. Like I said, what have they got? Well, these are the ones he's added to. Are any of them meeting my requirement? And by the way, that's how he's holding cash. So don't, get too excited about that. And I'd look at that and I'd say, okay, what are the ones which might tick my boxes? Does Ross Stores, for instance, does Disney tick our boxes? And it just so happens, yeah, actually. So that reduces the numbers. But that's just used as a number reduction method, not a replacement for filtering and everything else, because otherwise you might end up with stuff that actually is not going to go anywhere. Now, I've revealed quite a lot of stuff to you. It's critical that you can scan fast, because there's otherwise too much work across 10,000 for your SIP or ISA. You shouldn't be monitoring this frequently, because the more you monitor it, the more you're going to trade your investments, which is stupid. It should be more like Warren Buffett and say, right, my exit is this price. If it's not hit that price, I don't need to keep staring at it. What it does in between, it's like looking at an ant in a matchbox. Oh, it's moving around. Let me just keep staring at it. That's the market. Okay. One strategy is the one we use. We don't go around hypothecating different strategies, value growth, income, momentum, etc., etc. We don't say, oh, well, we're going to change this. What we found with private investors is they have a nasty habit of being gamblers. They'll suddenly come up with new ideas that they're totally untested, and then they'll throw their hard-earned money at them. It is nuts. The job of a pension is to clone yourself. So in your old age, this is working when you're not working, and I'll show you the maths on it in a second. Okay, so you might say 60% in stocks, 20% in low volatility exchange traded funds, 5 of those. Each one of those will have, say, 40 securities in it. So it gives you a good degree of low volatility, and then the rest in cash. And the cash should be able to get about 4.7% at the moment, right? The reason there is so much what's called Muppet money, and this is all the way from 2020, 1.5 trillion of cash stored in savings accounts, according to the Bank of England, without people actually investing it, is because they don't know what to do. They know they don't want to give it to bloody investment trusts and fund managers, because they know they're rubbish and they're going to just destroy it. Okay. And underperformance is the number one reason. People say, well, what if you have the data and you can see for yourself why you're in something, why you bought it, and what your expected gain is, and what your exit strategy is? Well, that doesn't actually take much time. It takes we have a little form we get new clients to fill in. It takes about 7 minutes to work out their risk appetite. And once you give people all the data, it takes about 7 minutes for them to do. And then they just need to monitor it maybe once a fortnight, once a month. The underperformance issue is particularly worrying because there's some very big names out there doing that, and yet they're advertising like crazy on social media. There's this one, which I'm sure people are tired of me mentioning. Fidelity, sadly, 91. I mean, I'll show you their fees. 10% in 5 years is their fees. Okay. You got Fidelity again. Listen, don't get me wrong. If I could create a fund with 10 billion or 50 billion of assets under management, I too would probably fall foul of this equally. If I was prime minister and people gave me free clothes, maybe I too would do that. I don't know. I don't want to be holier than thou. I'd like to think I wouldn't, but that's the problem we've got here. That these people are not going to tell you that they can't hold cash, that they're picking from a very small, narrow group of equities, and therefore it's highly unlikely they're going to outperform a benchmark you could just use as an index tracker on an exchange traded fund anyway. Turkeys don't say, don't shoot us. Okay, they say, hey, listen, we're really tasty, stay with us a while. So what are the biggest mistakes I want you to avoid in your pensions and savings? If you take nothing away from this, education is bloody invaluable. At least take that away. Okay, they're not doing obvious but quick analysis. They're not looking at all the most important factors, which, look, for valuation, for those of you who think there's some holy grail, there isn't. Undervalued, you can use price earnings growth, price to book. I don't care which, as long as you're not having overvalued companies. It's disconfirmation you're looking for, not confirmation. And that's the mistake people make as well. Sales growth, earnings growth, year-on-year growth, not fall. I don't care if you look for 10% or 100. There isn't a magic number as such. We're just trying to remove all the dross, because most of it is dross in the markets. Okay, got that? Dividends, ideal, but they're actually not that important. Momentum's far more important. It's as important as valuation and growth, actually. Growth is half as important as valuation. Momentum's probably as important as valuation when it comes to how likely things are to move ahead. And if you haven't read the research on it, just look at the Nobel Prize-winning research from, say, Eugene Fama, for argument's sake, or psychologically on Richard Thaler and Daniel Kahneman. Okay, statistics. Please, if none of these, if you don't look at any of these, volatility, you can get that off the internet, under 20%, please. Sortino, preferably above 1, preferably, rare to get that. And alpha, just any number, but positive, please. Okay, not knowing when to hold and when to sell, typical mistake. For me, it's really simple. There's only 3 types of market falls. Okay, baby bears, the smaller ones. How do you know? Well, the momentum is still rising. Mama bears, which you can ignore, the momentum is falling. Okay. And daddy bears, they're the only ones you can't ignore. That's when the momentum falls below its own moving average. Okay. What these lines are is just simply a measure of short and longer term average price movements and the differential between them. It is pattern recognition. AI would call it pattern recognition. It is correlations. They are not guaranteed to work, but mathematical objectivity, 1 + 1, we can all objectively agree equals 2. But who's wrong in the Middle East? We will all disagree. Because one thing's objective, the other, there might be some objective truth, but we'll have to find somebody to measure it by, and nobody can seem to agree. But 1 + 1, I'm pretty sure whoever your God is, you'll agree is 2. I'm sure there's some idiot out there on social media who won't, but there we go. So that's why we try to use mathematical measures, because it's far better to objectively be wrong than narratively be right once and then narratively wrong on multiple other occasions. Okay. The thing you can measure objectively, you can at least tweak until the majority of times you're right. The things you can't measure objectively and you just have to do it on narrative, you've got no guarantee it's ever going to happen again. Anyway, the approach, value, growth, income, Sortino, alpha that I've been talking about, 54% in 12 months. Then, now, can we do that every year? Of course not. The variance is huge because the market variance is huge. Why was it 54% in 2020, 21? Because the market had gone up so much. We had a bloody tailwind, not because we're a genius. Did I know Crocs was going to go up 208%? No, that's why I have more than one stock and why Warren Buffett has more than one stock. He doesn't know what any individual stock will go up. All he knows is if there's a good tailwind, it should do well. Most of the time, he sits and has an empty diary for that reason. And it's exactly the same with us. Because in 2022, the year after this, it was 0% return because we had to hold cash for most of the year. Did we know that? No, we didn't know we'd have to at the start of the year. We just January, waited till February till March. So wait a minute, why couldn't you pick winning stocks in 2022? Because there were bloody hardly any. I can't create companies which don't exist, which is the other mistake people make. They seem to think there are companies that exist which don't, not having an exit plan. 12 months, or if it drops 20%, 25%, either from the high since you bought it, if you're more risk loving, or from the entry price if you're a bit more risk averse. Okay. Mistake 5, look at too few stocks. That's a fund manager at St. James's Place. That's his part-time job. Okay. He's looking for stock ideas in there, right? if you're looking at too few stocks, so you're only looking at UK market or Australian or Vietnamese, it doesn't help you, the pensioner, if you buy a bit of each one of those, because each one of those is going to fail individually because they're only looking at a small market size. I'm afraid you want to get the big look at absolutely everything and start from there. Okay, you're paying more to fund managers than you realize. I'll tell you that now. This is 91, the fund 91. Ask your employer, who's my money with? If it's with these guys, well, look at page 46 of their PDF. Ask HR or whoever to get you the document. And this is what one of our clients, we showed them, and he didn't even know. He was paying 10%. Look, £10,000 after 5 years, 10%. Why is that their recommended holding period? Because they know statistically over a bloody 5-year period, you're not going to have lost money. But your job isn't not to lose money. A bank can do that. You don't need to go to a bloody fund manager not to lose money. Your job, presumably, even if only 10% of your money's in stocks, is to make at least double what's in a bank, given the volatility involved. Otherwise, just shove it in a bank and shut up. Okay? So that's the fundamental problem right there, is they're paying you, they're charging you, and you're saying, do you know what? My level is just, if you can do a bit better than a bank, geez, that's not what it's meant to be. If you want a little better than a bank, don't give it to a fund manager. Go to a bloody better bank. Okay, right? Just don't do that. Okay, Alejandro. Thanks for these webinars, Alpesh. You said earlier you were going to talk about Pepsi. Is that still on the table? Thanks. Yeah, I'll throw up Pepsi in a second. Actually, let me throw up Pepsi because it came up earlier actually in one of my recordings. So just in case it's missed off here, I will put it up. So I asked my team to do what a 40% projection looks like. There is no chance on God's green earth this is going to have a 40% rise. Bank of America gave it a buy. That I do not see in 12 months giving 40%. So there's a problem with it in that regard. Where would you, with something like this, put a stop loss? You'd put a stop loss here. So that's pretty nice and tight. You might go lower and say, I'll just put a 10% stop loss. That's not bad. Because then if you can get a 20% return, which is below what I'd want, so I wouldn't buy Pepsi because, sorry, if it goes to here in a year, that's too little for me. Unless it can reasonably look at 40% in 12 months, it won't meet my hurdle rate. When we set up the hedge fund in 2004, we asked the Mittel family office for funds to invest in our fund, and they said their hurdle rate is 22%. Okay, which means they're targeting 40%, and then some will work, some won't. They'll end up with 20. So you can see this won't. I don't see that doing that, and I'll tell you why. Because historically, yeah, you could say, well, it did it there, Alpesh. It might do it again. It's done it there, and that's why my team put this up. So they pitch ideas to me like in billions. And their argument was, look, a couple of times it's done it. This is one of those times. I said, oh, I'm not sure. You've got a 4-1 if they're right. If my team's right and I'm wrong, you've got a 4-1 on that one. Okay. It doesn't fall into my normal great investments program because it wasn't a 7, 8, or 9 or 10 on the value growth income, and the momentum is currently still falling. Okay. But yeah, there's the Pepsi one for you. Do you include US listed ADRs? I do indeed, Peter, because US listed ADRs are on the New York Stock Exchange. And I look at everything on New York Stock Exchange, everything on NASDAQ, everything on the London Stock Exchange, and everything on the London Stock Exchange, which is European. So there's a lot of good European companies that you can have as well. This came in from someone. This is what I mean. Please ask your fund manager, your HR, your employer, legal and general. Oh my God. I mean, if I make a list of the funds that come up, and the fund managers and the talk, well, these guys, I'm afraid, are in there a lot. Honestly, it is shocking just reading that she got 20% growth in 10 years. And with me, 20% within the year. Now, it's not because we put her in high-risk stuff. They manage their own, they make their own decisions. It was because the fund manager hadn't given her the stocks she wanted, basically, okay? Hadn't given her what she wanted. My approach is this. It's the same as Jim Simons, who's the greatest fund manager in history. He produced 39% per annum after fees since 1988 to 2018. I mean, amazing man. I have no opinions on any stocks. The computer has its opinions, and we slavishly follow them. That's it. They don't, and I don't run something where somebody goes, "Hey, Alpesh, I really like." So when my team pitched PepsiCo, it was based upon the computer analysis, and they said, look, do you want to talk about this? And I said, well, there's a limited number I'll talk about. This doesn't fit into my program. So no. Okay. The computer has its opinions. We slavishly follow those. That's the target I'm looking for. So is that 40 realistic? Well, historically, we know the hedge funds have got it. We know Jim Simons have got it. We know the trajectory and what these individual stocks have done. But how does that guarantee it might happen in the future? It doesn't guarantee a thing. What it means is if there's a tailwind, it might happen. If there's high Sortino and alpha, it might happen. Like 2023, 2021, the markets were going up like crazy. They may never go up ever again. It's not going to happen by looking at UK and emerging markets. You might get one or two. You just do not have enough choice. They don't create enough companies. It's not the economy that's the problem, believe it or not. I mean, it's sort of slightly related to that, but it's more because actually, if you look at GDP growth in the UK and the US, sometimes it's, or for prolonged periods, it's pretty similar. But the stock market has shot up on one or the other. I know one economy is bigger, but the point is this: they just don't create. We don't create as many listed companies here, so there's less choice. If you've got less choice, there's going to be a hell of a lot harder finding stuff which is going to go up. Okay, you need to be able to go into cash in bad years. If you don't have a strategy for that, all that's going to happen is you're going to make money for 5 years, lose it in the 6th. In those 5 years, every asset management company knows when the years are good, market like crazy, bring the money in. Okay. And in the 1 year when people have gone down, you told them to hold for 5 years anyway. You just keep the spiel. Oh, well, in the long run, markets will go up. Don't worry, blah, blah, blah. The fact that you've cost them that they're only going to get slightly more than a bank account and not say double their money in 5 years. Now it's going to be 17 years. Well, what are they going to do? And that's what their fund managers are relying on. Good years need to make up for bad, because there will be bad years. Like 2022 for us was 0% return. I'll say it again, 0% return. We're going, what's your average return? Well, in 2022, the average was 0 because we had to stay out of the market, which happens once every few years. In the same way, last year was not a typical year. I know it wasn't a typical year because that's what happened if you selected our January picks. Okay. In 2023 and held them to the end of the year. That's not typical. You still would have ended up with minus 1.68% there, but a few of them paid for everything else. 80% is not a bloody typical year for our selections. And these were based on value growth income, 7, 8, 9, or 10, rising MACD, etc., etc. And this is how they looked at the end of the year. By the end of the year, okay, you can see they were overvalued, many of them, and they'd slowed down their growing. It didn't matter because at the start it was fine. So we don't exit on the same rules as entry. Exit is 12 months or the stop loss is hit, okay? Or take profit is hit. There you go. Does that require much monitoring? Actually, it doesn't, because it's a 12-month period. It's not day-to-day. We're not trading. We don't want to trade. We want to take the more Warren Buffett approach of investing in good quality companies and then letting the market do its thing and wait. Not forever, because you can't use today's set of accounts and then say we're going to hold this company for 50 years because the accounts from today look good. Well, 50 years from now, the world will have changed. It changes in 12 months. That's why. And by the way, for those who don't know, and you don't have to use Barclays, you can use anybody. I'm not affiliated to them. To open a SIPP or ISA, it's just like opening a bank account. I had to explain this to some friends recently because they thought, oh, this all sounds awfully complicated. And I said, well, no, it's not. Okay. These are not the only brokers out there. I'm not affiliated to any of them. What I'm saying to you is be careful when you look at the headline rates, because actually, when you speak to them and say, look, I want to do this size investment, how much would it cost with you? They usually have caps and so on. So they're not as expensive as they might otherwise look, any of these. Some are more expensive than others, I grant you. Also, it's very important that you look at, say, that, because if you look at, say, somebody like this, you might think, oh, bloody hell, it's too expensive. Actually, in your SIPP, you can just keep it in, say, US dollars if you sell a stock. And you're not going to sell it too often because you're holding for 12 months. Now, let's say you plan to invest over 10 years and you improve your performance with a bit of knowledge that I give you and the data I give you. And let's say you got 100K and you plan to add 1.5 each month in your portfolio. Well, you should have $1 million after 10 years. That's your goal. That's your goal, because in your 9th to 10th year, you've cloned yourself. So your income should be about 100,000 from the portfolio. cloning yourself. That is the point of a pension. Okay. That is what should be happening after that year. Now, it won't go up in a straight line. I wish it did. It won't. There'll be some years which are better than others. Like I said, 2022, cash for God's sake. And the past doesn't guarantee the future. The markets might never, ever rise again, ever, from this day forth. Hasn't happened historically, which is why the past is probably a good guide to the future, but it's certainly not a guarantee because, well, nothing's a guarantee of the future. Look at the world around you. But this is the end goal. Now, if you can get that a bit sooner, great. You were lucky and your greed paid off. Okay. I want it sooner. Why? Well, with all my expertise and all that data and all that number crunching, of course I want it sooner. It's as simple as that. Don't worry about this. What this essentially shows is if you improve performance by even a tiny bit, it makes a far bigger impact than increasing your savings. So if you think, oh, I'll increase my savings rate into my pension, therefore I'll have more money. Actually, if you can improve your performance by even 1%, it makes a massive difference, as you will know because of compounding. So yeah, it's a lot harder to save more and forego holidays and the like, and it's a hell of a lot easier to improve performance by just having better data. I showed this and somebody once said, well, what else is there other than this? How do we know more? Well, for our UK selections, and if you want to see UK performance, it's been independently real-time examined, not back-tested, real-time since 2004. That's 18% per annum in the UK, where the UK over the same period generated 4%. The US is significantly, I'm not going to say how much more better because it sounds ridiculous, because the US markets did significantly better, but the UK market was 18% per annum with UK stocks from 2004 to 20 for 20 years. Okay. Also in 2004, I won this and used the profile to raise a hedge fund, which retail clients can't invest in, so don't ask. It's institutional money. So our investors are Aegon pension funds, basically. Now, he's not the only one. There's a lot of them who have to apologize. They gave him, after this, 9.2 billion. They didn't give me any billion after this. Can you believe it? Why? Well, because he's got a squarer jawline, apparently. Mine was a bit rounded. I was too fat. Basic problem. Now, stocks. How many? After you get about 20 to 40, you are not reducing market risk. Okay? So just wanted to let you know that. These are the companies that have paid to speak to their clients in there as well. So that's been wonderful. There's just some of them. Barclays, I launched one of my books. You should all have had the book by now, actually. It should have, who are on the thing. So you should have had a copy of the book. I'll share a few other things with you as well. There we go. Okay. That's why I've written about all of these approaches using the Nobel Prize winners' data. I'm not original. Didn't think of any of this stuff. I just thought I'd steal from the best, including Goldman Sachs. So this was a slide I took when I first launched the fund. A couple of years later, we launched a private equity fund, which my partners run. In fairness to them, I don't. I know as much about private equity as anybody else, but they run the private equity side. And Goldman Sachs invited me for a lunch with Jim O'Neill, now Lord O'Neill, and they showed us this from their quantum database, and I loved it. I stole it. I kept it. Okay, Goldman Sachs, Croakey. What they discovered is companies with, and they were displaying this to us. So just so you know how Goldman Sachs Wealth Management works, they're pitching to us why we should give them money. This is their latest research, and they said this is what we've discovered as a good way of picking stocks. 30% per annum, companies that generate the most cash on capital. Now think about, if you buy a piece of capital like a money printing machine, you don't need to keep paying for it, but it keeps producing cash. That's essentially the most profitable, the companies which are most likely to go up in share price. Why cash? Why not profits? Why not revenue? There are many theories about why cash, not the other things. I'm sure you've got some of your own. I won't go into it now. But anyway, it meant that we needed to tick that box as well. And that's what we do with our filtered selections. When somebody then sends me their portfolio like this person did, I can instantly, when we review people's portfolios, we review them and we point out the problems that they've got. Too many funds with too many stocks. So they've probably got about 1,000 stocks that they don't realize, where because they've got so many funds, and each one of those funds probably has 100 stocks in it. Not all are stock funds, some are just bonds, which is fine. They're going to have exposure on a spray and pray basis, which is why they've got such poor performance over 6 months, right? Zero, basically. And then stocks have big holes in it. They haven't got good quality companies, either because they selected themselves or for whatever other reason. And this is the random, sporadic way in which people do things, which makes our life incredibly easy because we look very clever very quickly because they're in such a state, their pensions, to begin with. Brewin Dolphin, mentioned here by another one. Big fan of your post. Stuck with Brewin Dolphin. Saw your review of portfolios. Would be great for advice. Stock spread over 1,000 different companies in scattergun effect. And then Fisher invested, approached her and said, I think it was her, this one I've forgotten, just put it into our one fund. Same problem with individual funds. My eventual ambition is twofold: to get to 1 million people on TikTok and then sit on a beach in Bali and just have the people viewing great content. And but in all seriousness, it's to turn asset management on its head. This bit you can leave now if you're not interested. What I want to do, I want to turn asset management on its head in the way Uber turned taxis on their head and Airbnb turned hotels on their head. It doesn't mean you're removing those other things. It means what you're saying to people is, you keep control of it. We'll give you the data. We won't charge you a weekly, monthly fee. You just pay for it once. You get the data for life, get the education and access to the expert for life, but you keep your money. You select what you want based on that with our hand holding with any broker you want. So we don't manage your money and just recreate the problem, and you remove the middleman. There will be no middleman. To prove you can teach anybody, Naomi worked for me for 2 years, now as an investment manager. She had no background in finance. In fact, she was my secretary for 2 years and then went straight to Newton. And now she manages Polar Capital many, many millions. If you look at her SEC filings for any new funds she issues, it says on there, started a career, 2 years working at my company. Kirsty went on to be a pensions lawyer. Susan is now head of international communications at Wells Fargo. They're incredibly talented women. Kanira was at Imperial College as an engineer and now works in venture capital. She was probably the closest to pre-qualified in something because she had that Imperial College engineering degree. But the other three were not pre-qualified. They're outstandingly talented and incredibly hardworking and very clever individuals, which is why I said to them, you must leave and do something great, join big names. And they're wonderful at what they do. But the point is, you can take anybody and teach them, like I can teach you to drive. It's the same thing, and that's the mistake people make. And then they ask the wrong question. They say, can you do it for me? Can you hold? No, you should be doing it because the hand can be held. Just like learning to drive, once you've learned, your life is sorted, okay? Because if you just say to somebody, do it for me, you're just making the same problem repeated again. You should be learning to use your own SIP. That's why SIPs were created. The ideal scenario is it's self-paced. You can, thanks to Zoom calls, learn it. Convenient from regulated fund manager, but that's by the by. No travel or hotel costs. You shouldn't have to rely on one broker or anything. You can pick whoever you want. It could be Barclays, it could be Hargreaves Lansdown, AJ Bell, whatever. So you've got control and transparency. So you see the data. You know why you hold something. Because it's your pension. Guess what? I'm going to tell you a secret. Nobody cares about your pension as much as you do. Nobody else cares about your pension as much as you do. I've got some more questions, which I'm going to give up as well. By the way, these are some of the great reviews of my work. Bernard's from a hedge fund, Merrill Lynch, American Express, BBC, Financial Times, Coutts. So we thought, you know what, we've got to get this word out. We've got to promote this. We did interviews with the people who were on the program. We did video interviews because if we don't video interviews, people aren't going to believe how happy they are. I want to get 350 people, then go to venture capitalists. It was originally going to be 250, but I want to get a really large size. 350, go to venture capitalists, and then eventually float the company on the stock market, just the way St. James's Place has reached FTSE 100 status. I'm not saying I necessarily will do that, but that's actually the ambition, to make it into a $1 billion company. $1 billion company and 1 million followers on TikTok. We're 40% of the way there with TikTok, I can tell you that. So very pleased with that. That's the link if you want to join and have the work done for you. If you don't, you have learned so much for free, and I will continue giving lots of free education. That is my promise to you, as I've done since 1999. Well, the Financial Times cost you £1. The book you can download for free now anyway. And I bring people on board who are fed up with lack of transparency, lack of communication with their fund managers, so that they get all the data and they can do it themselves. And when they're on webinars, I give them an added bonus of actually cutting the price of it all. The reason I want to do this is because currently, being in asset management, I've noticed the biggest problem is retail are completely left out. We have institutional investors. The institutions are fine. Okay, they're always going to be fine. They've got tons of money. Even if they make 1% more than a bank rate, they're happy. You guys need a lot of catching up to do, especially those in their 40s and 50s whose pensions haven't caught up. So we're trying to work out, well, how would you price something like this, which is, I think, revolutionary in the asset management business, where you keep your own money. We don't manage your money for you, just to be absolutely clear on that. The two things people wanted were access to me, and I've got a team who help do all the work for me. So people go, how do you get the time? Zoom and access to me. I've got an event in Parliament on the 24th of October as well, and access to the data so they know how to use it. You cannot control your pension unless you have two things. One is the transparency that the data gives you. Two is the knowledge that the expert gives you that you can always call on to save you time. Because you need to save time, you need the knowledge, you need the transparency of the data. Those are the only three things you need. It's as simple as that. And then you work out to yourself, well, if I get even a 10% improvement on what I've been generating so far, then what is that? If you've got a 100K portfolio, 10K on that is, 10% on that is 10K, right? And that's in 1 year. But what if you did it more frequently? It's as simple as that. Now, I'm not saying we're ever going to get 55% ever again. Let's assume not, because 2022 was 0. So over 2 years, that was actually 22.5%. Okay, not phenomenal over 2 years, because that's the variance. And that's important to say. Last year was a ridiculous blowout year, to the point there's no point mentioning last year, because 2023 was, the NASDAQ went up 55%. Now, it's up 33 already this year. We'll see. But yeah, there are some ridiculous years. They're not because we find great companies, but because the market gives us the opportunity to do it. Anyway, for those who want to be part of this, and I limit it to 10 people at a time to make sure that the quality is maintained, then let me know. You would go there. It is first come, first serve. So if that link gets blocked, go to that one. I should also say to you, if you want to learn more and more, please feel free. There is a ton of free information on my YouTube channel as well, including BBC, where, there we go, it's me talking about oil. Eat this. So the oil price thing, where I said previously $100, and it looks like it's going to happen again. Anyway, you'll find a ton of free education information. When I'm on the BBC or any other channels, this is the information, the way in which I do things anyway. The major problem I'm trying to solve, and I think we're going to do it, and why not? Because it's a problem worth solving, is this one, the one that you can see on screen, that you just don't get an alternative which is doing what it's supposed to do. What it's supposed to do is give you a return and transparency, knowledge of what you hold, why you hold it, give you control. That's the whole point of a SIP, an ISA, or 401k. We've now got clients from Canada, America. I'll be meeting some of the American ones next week when I'm in the States, Australia, New Zealand, Middle East, of course, UK. But the major problem is people just aren't in control of their investments. Given that we had such positive commentary from so many different places, it became a no-brainer to do this. So there you go. I will also show you something else on this. Like I said, whilst there's a ton of free information, because I want to make sure we do sort of public-private, let's put it that way, where the public also gets stuff. And that's why I give you these webinars, so you can see all the public stuff. And you can look on the website at returns and all the rest of it. You can also see this. Oh, by the way, for those of you who are unsure, we're about to put the prices up again, I'm afraid, because we've just launched with the ETFs and with the hedge fund stuff. as well. So just to give you fair warning, Callan, how do you use momentum and previous trajectory to determine whether a stock can achieve 40% in a year? I just showed you the line. You saw the line on screen. I thought it's pretty easy, pretty quite clear. If a client were to ask that, I'd do a one-to-one call with them and show them. In fact, we have a video on that anyway, but you drew the line of previous growth or existing growth, and you projected forward for 12 months. You saw it on screen. At the end, could you show ETF slide again, please, on the tube? And of course, you're on the tube. So with exchange traded funds, thank you. You've mentioned exchange traded funds. Let me show you that. We're really looking at a projection of 40%, low volatility, so preferably volatility under 5%, but ideally even under 10% will do, and a reasonable stop loss at 20%. So we've got a multiple reward to risk upside. So some of the ones which have come up, and I don't want to give too many of these away because then my clients get a bit annoyed that I'm giving too much stuff away for free. On this, we looked at, and I do a video on this each month, so we give a new fresh list every month to clients, and in between on a private Telegram channel, they get to know even mid-month new things that are coming up out of the hedge funds or out of the banks and so on, as I showed earlier. And we'd show which ones we think and where we'd put the stop loss on them. Okay, so the projections. Now, normally we're not just looking at the statistics and the data from the computer. We also will use a tiebreaker. So as Jim Simon said, use the computer, but use a tiebreaker. And the tiebreaker might be, oh, okay, this has also got some other reason to have it. So it could be utilities, infrastructure, gold. This one we didn't like. And the reason it was just too all over the place, if I remember rightly. The data was just not strong enough. If we don't have good data, then we'll just say, well, stay clear. But the utilities did have the projection that we wanted by projecting that line of growth or even that one, and that would give us what a 12-month return might look like. It's not guaranteed. Nothing's guaranteed. But we also then looked at the Sortino, Alpha, and Momentum, and we could see that if we tick those boxes as well. Remember, nothing's guaranteed, but at least we had a greater than 50-50 probability on the upside to downside, but it needed more than a 50-50 probability because you're looking at a double upside to downside. So you really needed a strong case for the upside, which was Sortino, Alpha, Momentum, and you needed a tight stop loss where you could say, right, if it went down here, it must be that we're wrong. So you needed a situation where you could find out you're going to wrong very quickly. You could fail fast, in other words. That's critical. Otherwise, you move on. That's why you need to go through a lot of stuff. Repension law. If Labour reduces the 25 pension tax-free limit from 268 to 100K, will it take immediate effect? I honestly don't know. I was shocked that with schools, they really did it almost immediately. I know sometimes with petrol, they do it that night. At midnight tonight, petrol's going up. So I honestly don't know. Parliament is sovereign. One thing I know as a barrister is Parliament can enact any law. They can revoke the independence of India tomorrow if they've so wished. They can make any law. They can say up is down and down is up. So they could actually do anything. I have no special information on that to give you. I'm afraid I'm getting nervous and thinking of taking the current maximum now instead of spreading it out. I think a lot of people have done that. I have absolutely no extra information on that. Please take advice from well, it's not take advice from somebody in government because they won't tell you. It's confidential information. But take advice on your personal tax situation. If you did take it out, what would be the implications for you? Okay. And you must think about what those implications might be because you don't want to sort of be out of the frying pan into the fire. But I honestly don't know if they're going to do that at all, I'm afraid. And I really don't want to be in the business of terrifying you and saying, well, I think eventually what they're going to do is not that. Eventually, they might do a lot of things. Eventually, a lot of things might happen. But what you're asking is what's going to happen at the end of October in the budget and how immediate will it be? And to that, one thing I suspect, and I'm just guessing, is like even with petrol, they don't say from 6 o'clock today, price of beer is going up because obviously people have to make changes, to computer systems. So I suspect that would be a drag on them being able to do it instantly. But it is a fear a lot of people have, and I completely understand that. What would you do if you bought a stock properly filtered and after 6 months, the monthly MACD had crossed its yellow, but the drop has been 10% since bought? No, Gavin. The exit rule is 25% from entry. The MACD rule is only there for the quality 5+. And daddy bear for indices. Okay, so sometimes people ask this and say, no, you're overthinking it. It's you're not trading your investments. Okay. Thank you on the timings as well, everyone. Okay, any questions? Anybody in between? I've got some TikTokers on there as well. Oh, by the way, what you're seeing on screen there is some of the material. You don't need to read all of this. We give you all of this, but you don't need to read all of that by any means at all. It's just that we give you a lot of information. Oh, 7:22. I'm going to get going. Let me know. Thanks, Ravish. You said earlier. Oh, no, I've done that. Okay, I've answered all the questions, so that's fantastic. Thank you all for being on. I will play around with the timings. I'm in New York next year, so I'm not sure what timing that might be or whether next week might happen. But thank you all for being on. For those who need more time to think about it, more than happy to, if you leave your email, reserve a place while you think about it. That's perfectly perfectly reasonable. I don't want anybody making sort of snap decisions, but let me know if that is of interest. Thank you, Ian, and we'll try and give more and more and more in future. Remember, this bit's new, what the elite banks are doing, and what we've done is we've overlapped it with our own database, so it's sort of a hook to say, the bank also likes what we've selected, so it gives sort of not a reassurance, but a bit of extra oomph. And then we found there were some people who didn't want to wait 12 months. They wanted more sooner. You know, they might have 10% of their money for intermediate momentum investments. So we did those, and now they get those as well as part of the program. It's not strictly part of the program because it's not 12 months. 12 months is the program. But because we know some people wanted, well, what's got momentum? Like a JD.com, what we did is we said, okay, well, let's give some of these with where they'd put, it had to be a 2-for-1 reward to risk, 20 to 40% minimum to 20 at the bottom. Now, some said, no, thank you very much. Not for my pension, but I like watching the videos and learning. Okay, and that was perfectly fine as well. Thank you all so much, and thank you very much for your comments, Peter, Ian, Liam. Thank you very much. And I look forward to speaking to you all who've signed up after this webinar. I will be sending you an email to get you onboarded. So thank you very much. There was somebody who signed up just before the webinar started. So I'll make sure I send you the email. I didn't get a chance to send it before the webinar started. So thank you for that as well. And any other emails, calls, comments after this, just email me and I'll be happy to answer them. Thank you all very much. And well, yeah, stay safe and let's hope the world improves. But yeah, thank you. Thank you all. Ooh, let me see, where am I? I've lost myself now. I'm going to close all these windows, of which there are so many. Okay. And I'm going to, I showed you that earlier, so I'm going to close that one. Oh, somebody asked regarding the pricing. There is no ongoing charge. No, you just use that coupon code. Once you're in, that's it. Sorry, there were some messages on the private chat, not just the public one. Let me just go to the Q&A private chat. Yep, I've got your name. I can hold one for you. Not a problem. Happy to hold it for a week. Not a problem. And you can pay in installments, or you can do it in one go. Eventually, when it goes global and we have people from different parts of the world, we will, for future people, not for the people already on it, raise prices and change subscription models or whatever, depending on what the venture capitalists want. But for the people already on it, who have signed up, that won't ever change. Or for people signing up today, for instance, that won't ever change. But it provides evidence for us to give to the venture capitalists to say, look, this really works. We've got these people. These are their experiences. This is a sufficient period of time for you to look at it through market cycles. And this can be a different way of doing asset management. We had a wonderful quote from Edmund de Rothschild Private Bank, the vice president there. So I've put some extra ones here. Merrill Lynch, HSBC, chairman of the Chicago Board of Trade, now former chairman of the Chicago Board of Trade, but you get the idea. Okay. And yeah, and there's some more questions over there. So thank you all very much, and I will speak to you some other time. Thanks, everyone, and enjoy the rest of your evening. Whoops. He says, trying to Tim. I hope you're all ready and all comfortable and getting on with it. And as I said, we're going to also broadcast this live on TikTok. Why wouldn't you? Some 400,000 followers there. I work out that if I double that number in a bit, if I get to about 1 million followers, okay, then what I should be looking at is sitting on a beach and getting about 1 million a year in just passive income from blooming TikTok videos, which is extraordinary. Not how I thought life would pan out, but if it does, so be it. So are you all ready? It's now coming up to, should be at 6 o'clock, and we're ready for the webinar. I might even get something to do this in future. There we go. And I'm going to hit live on the TikTok side of stuff as well, because it's, as I said, incredibly popular to be on there. So I can see that you can all hear me. Let me know where you're from, and we're going to kick off as well. Found the new press for sound button. Oh, is there a sound button? I didn't know that. Hi from Pinner. Just let me know you can all hear me loud and clear. I'm going to move this up a little bit. Here we go. Good God, computers are difficult. Get ready. Get a pen and paper. You're going to want this, and you're going to want to get also a notepad and a camera phone, because you're going to want to take a view of some of these pics. So, excuse me while I do this, and hopefully don't destroy everything in the interim. He says bravely. Here we go. Busy old morning. I had to give a speech today in the centre of town. So I found the new press for sound button. Oh, is there a sound button? I didn't know that. Hi from Pinner. Just let me know you can all hear me loud and clear. I'm going to move this up a little bit. Here we go. I have a snazzy electric desk which I can move up. And as I said, we're broadcasting live on the talk as well. So let's get on with it. A heck of a